Well, let's move on now to the Democratic Republic of Congo. The country's government says that it will cut its public expenditure and encourage tax payments in the national currency. Now, this is all in a bid to prevent it from depreciating against the US dollar. That announcement was made by the country's finance minister amid a recent drop in the value of the Congolese franc. Here's CGTN's Chris Ochamringa with more from Kinshasa.
Rose Kabena ekes out a living selling fish and other foodstuffs at the Zigida market in Kinshasa. This is one of the busiest markets in the capital of the Democratic Republic of Congo. But traders say business has been slow over the past couple of months. A falling local currency against the dollar has led to an increase in prices of basic commodities.
Some of the products we sell come from Zambia. The traders over there don't accept to be paid in Congolese francs. We have to get dollars and buy their products. It's really tough for us. We ask our president to find a solution to bring the dollar rate down.
According to the DRC's central bank, the Congolese franc has lost more than 21% of its value against the US dollar since the beginning of the year. Increased government spending in preparation for elections in December and the purchase of arms to battle armed groups have significantly eaten into the country's foreign exchange reserves. Money changers in Kinshasa fear the dollar rate may rise higher in the coming weeks.
From the 1st of September until now, the dollar rate has remained at 2,500 Congolese francs. But when people start receiving their salaries at the end of the month, it's going to rise because those who are paid in Congolese francs will start looking for US dollars to pay their rent and other things.
Authorities have committed to cut public spending and encourage tax payments in Congolese francs instead of US dollars to stabilize the local currency. The DRC economy is largely dependent on export earnings from the mining sector.
There's no way to get foreign currency because our national production remains in the country. Our exports are only raw materials, which are not owned by the government, but by private companies. The government's only source of revenue is taxes, and that's why our currency is weak. A currency sustained by national production, which we don't have.
Uncontrolled inflation during the rule of former DRC President Mobutu Sese Seko in the 1990s led the country to start using dollars alongside their local currency. The recent rise in the dollar rate has led to an increase in prices of food for millions of people.
The DRC's agricultural resources have the potential to feed the country's population and export the surplus. But an armed conflict that has been going on for over 2 decades has displaced millions of people. The country now relies heavily on food imports, which has left its economy vulnerable to external shocks. Chris Ochamringa, CGTN, Kinshasa, Democratic Republic of Congo.